China is now pushing companies to move away from the US dollar. And at the same time, Japan is actively intervening in markets. Now, on the surface, this might not sound like a big deal, but it is. Because this isn't just about currencies. This is about the bond market, the stock market, and the entire U.S. economy. Let's start with the core issue. For years, the dollar and Treasury yields moved in a predictable pattern. When the dollar fell, yields would rise. When the dollar rose, yields would fall. But recently, something changed. They started moving together. And now, we're seeing early signs of a dangerous decoupling. The dollar is weakening, but yields are still going up. And that's a problem, because higher yields mean higher borrowing costs for businesses, for consumers, for the entire economy. Now combine that with rising energy prices. Oil is going up, gas is going up. So now you have higher costs and higher interest rates at the same time. That's the exact setup for stagflation. Now let's talk about China. China is trying to reduce its reliance on the dollar. Why? Because the dollar gives the U.S. power, sanctions, restrictions, control over global trade. So what's the workaround? You stop using dollars. You switch to other currencies, like the yuan. And if companies are holding dollars, they sell them, which means more supply of dollars in the market. And when supply goes up, value goes down. Now add Japan to the picture. Japan has been stepping into the market, trying to support its currency. How? By selling dollars. But here's the problem. Historically, this doesn't work long-term. And if Japan runs out of reserves, there's only one option left. Sell U.S. Treasuries. And that pushes yields even higher. Now think about this chain reaction. China selling dollars, Japan selling dollars, potential Treasury selling. What happens next? The dollar weakens, yields rise, and pressure builds on the entire system. But here's where it gets interesting. Despite all of this, the stock market is still going up. Why? Because something is holding it up. Corporate buybacks. Companies are buying back their own stock at record levels. We're talking over $1.5 trillion. And these buybacks buy every dip. On top of that, you've got funds, algorithms, systematic flows, all pushing markets higher. And then there's the final piece. FOMO. When markets go up, investors chase. They don't want to miss out. And that's how you get blow-off tops. But history tells us something important. There's always a breaking point. We saw it in 2000. We saw it in 2008. We saw it again in 2022. Rising yields, rising energy prices, eventually, they break the market. So where are we now? Right in the middle. Short term, the market can still go higher, much higher. But the risks are building. A weaker dollar, rising yields, higher energy prices. That combination has never ended well. So the real question is, not if something breaks, but when.